Welcome to Essentials of Healthcare Finance, Chapter 1. So this chapter is intended to introduce concepts of financial information, financial decision-making, and forms of ownership in healthcare organizations. As the healthcare industry continues to grow, it's important to understand cash flow management, how investment decisions are made, how financial information is used, and who uses it. The effectiveness of financial management in healthcare, as in any business, in part depends on information quality. And a good information system enables decision makers to choose a course of action with the highest probability of favorable results. The learning objectives for this chapter are to describe the importance of financial information in healthcare organizations, discuss the uses of financial information, list the users of financial information, describe the financial functions within an organization, and discuss the common ownership forms of healthcare organizations along with their advantages and disadvantages. Financial information is particularly important to analyze the financial condition or the viability of an organization. The financial condition helps determine whether or not an organization is capable to achieve its goal and function at a consistent level. The organization's financial information may help determine short and long-run effects and help evaluate investment decisions. In addition, financial information sheds light on efficiency and effectiveness of healthcare operations and provides data to perform cost-benefit analysis. The importance of financial information in summary involves cash flow management, investment decisions, long-term goals of the organization, with a main goal to reduce risk and maximize profit. There is rapid growth in the healthcare industry to include hospitals, long-term care facilities, home health, and ambulatory services. Healthcare costs are increasing. Healthcare cost spending at the time of this publication was 17% of the U.S. gross domestic product, or GDP. It is now edging closer to 19%. So increasingly important is the financial and cost information that goes into decision making. It is interesting to note that the healthcare industry differs from other business organizations in that there's a dominance of not-for-profit hospitals as opposed to for-profit in the United States, and the main source of revenue is reimbursement from the government and private insurers, meaning not directly from the patients, but through intermediaries or third-party facilitators. And the overall purpose of the healthcare industry is the contribution to social well-being. So those are some differences. As we mentioned about the expenditures of healthcare, you look at this chart from 2008 to 2024, you can see the types of expenditures going along down the left column, and across the top are the years. And you'll be able to see the illustration of the increase in costs just by looking across the bolded areas. Personal health care, drastic change from 2008, from just over 2,000 to 2,800 for 2016, up to 4,500 by 2024. Healthcare consumption expenditures, 2258 in 2008, almost doubled, more than doubled, to 5154 in 2024. Again, looking at the gross domestic product along the bottom, looking at the national health expenditures to GDP, you can see 16.4% in 2008 with a projection up to 19.6% in 2024. As it relates to financial information, the most common uses are evaluating the financial condition of an entity, evaluating stewardship within an entity, assessing the efficiency of operations, assessing the effectiveness of operations, and determining the compliance of the operation with internal and external directives. Not all decision makers are equally interested in every aspect of financial information an organization may have. Decision-making groups such as a governing board or rate-setting organization mostly use financial information to assess financial conditions and efficiency. The financial condition of an organization is the status of its assets, liabilities, and equity positions that are described in financial statements. It's equated with an organization's viability, and it is the most common use of financial information. The financial condition of an organization underlies most of its business decisions, and it includes assessment of short-term and long-term conditions. With the rapid growth of the healthcare sectors, it's becoming increasingly important for managers to understand and interpret financial information. Strategic decision-making is dependent on financial planning and cost evaluation, which leads into the concept of stewardship, which is management's responsibility to properly utilize the organization's resources, including people, property, and financial assets. It is historically the most important, and it's designed to prevent loss of assets through employees' malfeasance. Efficiency is the ratio of outputs to inputs, the lowest possible cost of production. It's becoming increasingly important given the increasing healthcare cost and lower reimbursement. It implies that there's an availability of standards or benchmarks for comparison to evaluate whether you're efficient or not. Effectiveness is the attainment of objectives through production of outputs. It is more difficult to measure as organizations do not always state their objectives quantitatively, but rather qualitatively. It gets less emphasis than efficiency, such as unnecessary services at an efficient price, simply because it's very objective and qualitative as opposed to quantitative. Compliance is simply whether or not an organization's directives are followed. Financial reporting is required to ensure compliance, such as through internal uses such as budgets, or external uses such as lenders or credit rating agencies. Table 1.3 shows the users and uses of financial information. The users are listed along the left-hand column, and the uses of financial information across the top. As you can look, you can see from external and internal users what their uses of financial information may be. There are two main duties of financial managers, controllership and treasurership. Controllers deal with internal finances, which are the direct preparation of financial statements and reports, the direct preparation of budgets, analyzing future earnings and expenses, developing internal control procedures, and preparing reports for regulatory agencies. Treasurers, on the other hand, deal with external finances. They establish billing, credit, and collection policies, manage investments, are responsible for securing financing, whether it be short-term or long-term, maintaining investment and credit rating relations, and analyzing merger and acquisition opportunities. Figure 1.2 is a typical financial organization chart of a typical hospital. Here they have a senior vice president and chief financial officer with 5 direct reports, being a controller, a director of patient accounting, a director of patient registration, director of corporate compliance and risk management, and a director of material management. With the controller having 2 direct reports, the director of financial reporting and disbursements, and the director of financial analysis. Chapter 1 also provides a brief overview of the main forms of business ownership in healthcare. The 4 main types of organizations in healthcare that are discussed are not-for-profit, business-oriented organizations, investor-owned healthcare entities, governmental healthcare, and non-governmental, non-profit healthcare organizations. The not-for-profit, business-oriented organizations have an objective function to maximize shareholder value versus profit maximization. The shareholders are the community versus individuals. Not-for-profits are exempt from federal income tax and most state and local property taxes, and they are required to provide community benefit. They may do this by the types of services that are offered or the percentage of care that is provided as charity care or things along those lines. They have a lower cost of equity capital than investor-owned, but are more limited in their ability to access capital. And what's interesting is at the present time, about 80% of hospitals are not-for-profit. With investor-owned healthcare entities, the shareholders are risk-based equity investors, and their objective function is to maximize profits for shareholders. They are able to access capital through debt and equity, but are also subject to double taxation. That is, they're taxed at both the corporate level and at the individual level for the shareholders. The main type of investor-owned entities are publicly traded entities, privately held, professional corporations or associations, sole proprietorships, limited partnerships, and limited liability companies. Publicly traded companies buy and sell shares of the firm on the open market. They're subject to reporting requirements and regulation by the Securities and Exchange Commission, and their advantage is the ability to raise equity capital through the sale of company stock. Privately held companies have shares that are held by few investors and are not available to the general public. The advantage is that they are subject to far fewer reporting requirements by the SEC. And up until recently, Hospital Corporation of America, or HCA, was the largest privately held hospital system. Professional corporations or associations are formed by professionals with the advantage of a corporation. Shareholders are free from personal liability, but professionals are liable. Widely used by physicians as it protects them from the liabilities of each other. Sole proprietorships are unincorporated businesses that are owned by a single individual. For example, a solo practicing physician. The advantages are it's easy and inexpensive to set up, there's no profit sharing, no government regulations, and no special income tax. But the disadvantage, and it's a big one, is unlimited liability and very limited access to capital. Limited partnerships are unincorporated businesses with 2 or more owners. The advantages are they're easy to form, they're subject to few government regulations, and they're not subject to double taxation. The disadvantage is there is unlimited liability by at least one partner, and who wants to be that person? And it's very difficult to dissolve, which creates potential for conflict among partners. LLCs, which are very common, are limited liability partnerships that combine the characteristics of partnership with the liability protection of a corporation. Liability of the general partner is limited, and there's flexibility to structure allocations of income and losses as the owners choose. They are required to follow tax allocation rules. Government healthcare organizations are public corporations that are owned by a state or local government. You may find them to be the hospital district. They have taxing authority, and that's how they develop and create access to additional revenues through taxes. They're not able to raise funds through equity investments, though, and like not-for-profits, they are exempt from property and income tax. One of the major things they may face is political pressure to return some of the earnings to the community or to reduce prices if earnings are too large. And so there's much discussion about reinvestment into capital infrastructure and staying current with medical technology. Not-for-profit, non-business-oriented organizations perform voluntary services in communities. They are tax exempt, but they rely primarily on public donations. Some examples would be the American Red Cross and the American Cancer Society.